Here with Stefano again.
Hey!
Welcome.
Long time no see.
Yeah. Just wanted to have him in to ask a couple quick questions about sort of typical business and what he sees with buyers qualifying and not qualifying and why things work and don't work, so you all can be better prepared. Stefano, what do you see going wrong the most with people that come into your office, call you? Is it getting pre-qualified? Is it during the process of closing on the home? Or what goes wrong?
It's usually pre-qualifying. I think a lot of it has to do with the fact that rates are high, so the cost of a mortgage is high, so that kind of skews the debt to income ratio a lot. Generally, the number one thing that I see is that people are not responsible with credit. What do I mean by that? Cars, credit cards, student loans, essentially any kind of form of debt that you can get your hands on. People are very, very, very over leveraged. You know, they have a ton of credit card debt. Student loan debt has been getting really, really bad lately, which is even worse considering the fact that they've been in a kind of a moratorium. They haven't, a lot of people haven't been making payments on the student loans.
So the debt's still up.
Yes, and I've seen plenty of those student loans that are negatively amortizing, so they're accruing interest on the principal balance while they don't make payments. So say they took it out for $5 grand, and then a few years later it's at $6 grand, and then you extrapolate that over a bunch of, it's really bad.
Yeah.
But that's the number one problem that I see. And you can point to a lot of different things to explain that. Like, oh, there's a lack of financial education. People aren't making enough money to keep up with the cost of life. So they have to take out debt and they have to run up their credit cards to live, blah, 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 blah. There's a lot of different ways to rationalize it. And of course, everybody is a different case-by-case basis. But yes, the number one problem that I see is that people are not responsible with debt. And that's just part of, you know, America. We are a debt-based country, debt-based society.
Yeah, and like you said, there's more things going on that are adding to that, you know?
Yes, it makes it hard, right? So yeah, debt is the number one problem. I don't suspect that to ever really change, but especially now with,
and it's a surprise because people know how much they make and they can kind of put that into some sort of form online and figure out what they qualify for just with the strictly like income-based thing.
Yeah.
That's the detail stuff that the lenders actually need. Is the debt and all that too.
Yeah, and a lot of people are blissfully unaware of their own debt load because they don't want to really think about it because it's kind of, it's a very vulnerable position to be in, and it's not fun. So debt is the number one. I'd say honestly the number two right now is that quite frankly people just do not make enough money.
Yeah.
The growth of wages is been trailing far, far behind the cost of living. So that kind of feeds into, you know, the debt problem. When the cost of living is so high and you're not making enough money, a lot of people will turn to short-term debt to make up that, difference. And that can be really bad. So, and there's not really too much that people can really do about that. I mean, sure, you could go get a higher paying job per se, but it's much easier said than done, you know. And lastly, the third is that the cost of living, as far as, you know, mortgage rates, rent, whatever it may be, is very, very expensive. And like I said earlier, that eats into a lot of people's debt to income very, very heavily. Like you could find somebody that makes 80 grand a year, has very, very little debt, but then they find a place for 450 grand and the rate is 7% and they don't have a ton of money, so they're putting 3 or 5% down, the mortgage is going to be so expensive that it's going to, you know, eat up essentially all of their qualifying income, puts them in a tough spot where, you know, 50% of their pre-tax income is going to the mortgage.
Right.
So yeah, debt, income, and just the cost of housing is very expensive.
Yeah, that percentage, I think that also has thrown people for a loop too, because if they maybe pre-qualified a few years ago,
no, it's not even,
it's not the same.
Not even close.
Yeah.
Not even close. And you know, the term house poor can mean a lot of things, but I think now with the cost of borrowing being so high, and just the general inability for most people to put themselves in a situation to even save any money for a down payment or, you know, other things in life, puts a lot of people in a situation where if they are borrowing for housing, they're essentially borrowing up to the max that they can. and they're highly leveraging themselves in housing, which, you know, carries its own risks.
Yeah, so then it's just all about whether the payment's affordable for you, which the bank's not gonna want you to take a loan out that you can't afford month to month. But if you have a job that you feel like is going to change or could change or isn't stable enough, you know, keep all of that in mind, you know, going into it, because you need to maintain those payments for at least a few years before you can cash out. Yeah. I will say though, you know, my personal opinion and what I've sort of based all of my history on with real estate is based on what my dad said, was that he could never save any money until they bought a house, and then he instantly started saving money. And that was definitely my position too. Like the first place I bought, it was like $7,000 was the 3.5% on it.
$7,000?
It was only like 12 years ago.
Oh my God.
But yeah, it was, you know, a 1-bedroom condo, 190, you know, so yeah, but I swear, like within 2 years, I had a down payment on a $500,000
Oh, I thought you
house.
said that the house was $7,000.
No.
Oh my God, I was about to say, what are you
talking
about?
Like,
I totally misheard you.
1920? No.
Yeah, maybe.
1980, actually. I had friends, one of my best friends, her parents bought a place in Arlington, North Arlington, for $14,000. It's now worth like 2.4 or something. In 1984 or something?
That wasn't even that long ago.
Yeah,
it was like 4 years ago.
Yeah.
Should have been born earlier.
I know, just like, yeah, a couple minutes earlier. It's crazy. But anyways, my dad was like, we could never save any money until we bought our first place. And then same thing. So, you know, I'm living by that principle, of course. But I mean, I had saved enough money for a new place within 2 or 3 years for, you know, whatever down payment is on a $500,000 house, you know, so like it really does start to grow, you know, your, so there is that plus. I think if you can get a home, it's always good to do it because it's going to start paying for itself. You just have to make sure you're stable enough to do it.
It's a long-term play.
Yeah.
But that's how you're supposed to look at money. Money should be in the long term.
Yeah.
So.
Yeah. So you mentioned like a person who makes $80,000, and that struck me as a question for you. Roughly, what would you say somebody who makes $80,000 and has good enough credit, you know, 700-ish, what do you think the house price that they could afford would be?
Well, let's see some quick math on that. The math is pretty straightforward. We can use 50% of your monthly income before tax to pay your mortgage. So if you make 80 grand divided by 12, $6,600 a month times 50% is $33.33. So if you had no debt at all, you could pay $33.33 a month for your mortgage. Let's assume you have, I don't know, $800 a month in debt.
Yeah.
That makes your qualifying income $2,533. What can you afford with $2,533?
Wait, let me guess.
Can you guess?
Yeah, I'm gonna guess.
Go ahead.
$460,000.
Like
400.
350 maybe.
I thought you could get a place.
No, it's this mortgage rate, 7%.
Okay. Wait,
what could you get? You could get much more at like a 3.5, 4%.
Well, right, but I thought I was right because I thought you could get like a $500,000 house for a $3,000.
No, for 500 grand, you're probably going to be paying somewhere in the ballpark of like 3,500, 240, 200. It depends on taxes, insurance, disclaimers, obviously.
So $3,500
down
for
payment.
a $500,000 house. So like maybe then a $600,000 house would be what, $4,200.
I mean, it totally depends on where rates are. That's just essentially just because of rates. The rates are killing it, but also property taxes. That's part of why you can't really buy much with $2,500 or $3,000 a month here. Property taxes are very, very high. Property taxes are high. Insurance is expensive.
In 360, you're going to have a condo fee or an HOA.
And then there's a condo fee if you want to buy a condo.
Yeah.
That's the problem. A lot of people, they try to buy a condo.
Yeah.
Because, you know.
But that's why it's also very important to talk. I mean, there's a million reasons why, and I think if you listen to what he was saying, you'll pick through that. You have to talk to a lender early, because if you aren't calculating the condo fees in there, you could be looking at condos for months and not even qualify. Maybe you could have gotten a townhouse because the HOA is lower than the condo fee, but you just don't know that.
Yeah.
But yeah, so very important.
Sometimes the condo fees are so egregiously expensive that it's essentially like you're buying a single family or townhome after all said and done.
Exactly. So when you are making those decisions, just have a good open discussion with your realtor and your lender, because they'll both be able to help you a bit on that and let you know what you're saving on a townhouse versus a house versus a condo.
Right.
And get you filtered for the right properties and stuff. And I know when people reach out to me, I'm able to set up a search where I limit the condo fee. So we don't have to look at 1 bedrooms with $1,200 condo fees. We can look at just 1 bedrooms with $600 condo fees or less.
Yeah.
So you're not seeing everything on Zillow or whatever. You're just seeing the ones that you will be able to make a payment on. You know?
Yeah.
That's
yeah.
important.
The condos can get expensive, very expensive, which is, you know, unfortunate. But if you need something lower end on the price to move into your first home, or if you just don't need something that's super big and expensive, it's probably your best bet.
Yeah, and sometimes the condo can have its own draw if you want garage parking and you want a pool. So there's certainly features that you're paying for with that condo fee at some places not as much. But
Depends. Thanks for listening.
Yeah, thanks for
having me.
Thanks for tuning in. Thanks for coming. Yeah.
As always.
Take care, everybody.
Bye. All right. Right on.